Hello, everyone, and welcome to the webinar. I'm Cecilia Ferrara, Director of the NCBFAA Educational Institute, and I'd like to thank you for joining us for today's presentation. Before we get started, I would like to remind you that all attendees are in listen-only mode. However, you can type questions into the question box on the webinar toolbar at any time, which, time permitting, we will address at the end of the presentation. I'm excited to welcome our panel of experts, also known as the Forex Dream Team, as our speakers today. Andrew Wolflein, Chief Strategy Officer, John Min, Chief Economist, and John Doyle, VP of Dealing and Trading, all from Tempus, Inc., will be presenting for us today. Founded in 1999, Tempus provides corporate clients with industry-leading foreign exchange and global payment solutions. Based in D.C., Tempus was ranked the #1 overall G10 currency forecaster by Bloomberg for the first 2 quarters of 2017. Together with its global affiliates, Tempus leverages a combined annual FX volume of over $150 billion to help more than 50,000 clients from a broad range of industries successfully navigate the global currency markets and market fluctuations. We are thrilled that they are able to offer their expertise to us today, so without further delay, I will get the presentation started and turn it over to Mr. John Doyle.
Thank you very much. I appreciate it. Before we get started, we'll just do a little rundown of what we will be speaking about today. First, we're going to be talking about how we're going to navigate currency fluctuations. It's mostly my job here at Tempus, so I'll take you through that. And then we'll pass it on to Dr. Min, who will talk about different payments solutions in the FX market, and also ways to hedge any foreign currency risk that your company might have. And then Mr. Wolflein, Andrew, will take us through a new technology that's out in the market and in the media a lot, with the blockchain technology and some cryptocurrencies, and then also take us through some of the compliance trends and things that we see in our industry and in the global marketplace. So that's what we'll get started with me, and you'll hear the word FX a couple of times throughout the presentation. Just to remind you, that just is slang for foreign exchange, and we'll use those terms interchangeably. If you're on this webinar, you probably know what foreign currency is, but I'll give a little bit of brief history. Obviously, currency exchange is something that's happened even since the beginning of modern history and even in biblical times. Today, FX is the largest market in the world. It's also the most liquid, meaning the most money is flowing through this market. $5.2 trillion worth of currency is traded every single day. And to give you an idea, that's over 50 times more volume than is on the New York Stock Exchange every day. So it's very large. Inside of that market, obviously, there's hundreds of different currencies that can be traded. And each currency we talk about is really a currency pair. There's 2 sides. So if we talk about the euro in the United States, we're usually talking about the US dollar versus the euro. But obviously, because there's hundreds of currencies in different pairs, there's even thousands of different pairs of currencies out there that are traded. And also, unlike the stock market, FX markets are open 24 hours a day. So once we're done here in the United States in our session, the world keeps spinning and it moves on to Asia and then back to Europe and then back around here. So there's no closing of like we would see with stocks in a closing bell. It just moves from one market to the next market, except for the weekends where everyone gets a little rest. Inside of that, now that we know what the FX market is, it's hard to know where currencies are going to move and what exactly moves FX markets. There's quite literally hundreds of things that could move a currency pair one way or the other. Obviously, it's in economics, like your high school 101 econ class, the price of a certain currency has a lot to do with the amount of buyers and sellers, right? Focuses on supply and demand, and that is true all the way through. But what creates that supply and demand? There's a number of different things that affect it. A lot of them are macro economic factors. The thing that's been moving currency markets probably the most over the last number of years are central bank policies, monetary policy. Obviously, here in the United States, we have the Federal Reserve, and their actions over the last number of years have directly impacted the U.S. dollar versus most of our counterparts. You may remember the dollar had a great year in 2016 because we were the only central bank here in the United States, major central bank, that was pulling in its quantitative easing and moving towards raising interest rates, while the rest of the global central banks were keeping a very relatively easy monetary policy. But of course, central banks, they don't work in a vacuum. They need things to make decisions on, and that leads us to fundamental data that central banks use to dictate our own monetary policy. GDP, gross domestic product, unemployment rate, wages, retail sales. These are some of the major fundamental pieces of data that come across the screen that can affect each individual currency. And then there's some smaller ones too. And you have retail sales is the biggest one, sometimes because it's 70% of the U.S. economy is based on consumer purchases. But we have other types of data that come out like like new home sales, existing home sales, second tier data that is all still very important to the dollar or to each individual currency and the central bankers that make our monetary policy. Moving on, there's also capital markets such as bond markets and stock markets that have a lot of effect on currency markets. For instance, we could talk about the Japanese yen, which is a safe haven currency, meaning if the market dives, sellers of stocks need to take those funds and move them somewhere. And due to the perceived relative safety of the Japanese yen, a lot of that flow goes into the yen, and the yen strengthens. In addition to that, geopolitical conditions such as wars and elections, things like that, have a great effect on currencies. The biggest one that you probably are aware of in the last year and a half or so was Brexit in the UK. It came as a surprise to many in the market, and the pound fell to historic lows versus the dollar. So that was one example. Other things that are happening now that we're paying attention to are the NAFTA negotiations or renegotiations on whether this large trading agreement will stay in place or not. Periodically, there are threats from North Korea, and the market reacts in different ways to those perceived threats. And just recently, we had some elections in the Eurozone that traders were paying special attention to. We had some kind of far right, out of the mainstream candidates out there. In the end, I guess the middle kind of held, and the euro survived. But those were very real threats for the euro much of last year. And then the other thing that can really affect currency markets, especially for commodity-based currencies, are the prices of commodities. It's quite well known that Canada is a large producer of oil, so the value of their currency is a lot of times directly related to the price of oil. Some lesser known examples would be iron ore affecting the strength or weakness of the Australian dollar, and one of my favorites is actually powdered milk prices directly affect the strength or weakness of the New Zealand dollar, which is one of my more fun things I get to write about. Yes, I'm kind of a dork. Now we know all the things that might affect the market, but that doesn't mean that we have crystal clear foresight into some unseen things, and it really it shows the importance of timing when someone is in the market trying to buy or sell currency. So here's a not so distant example of when this happened. In this example, you can see on the screen, the Bank of Canada unexpectedly cut its main interest rate by 0.25%. And I say unexpectedly, meaning most of the market in the futures market expected them to keep rates on hold. So what happened was the Canadian dollar immediately started selling. And you can see that the Canadian dollar lost 2% versus the US dollar in just 5 minutes. It ended the day 2.5%. But just in those 5 minutes, if you were a company who was needing to sell $1 million Canadian dollars, you can see there at a rate of 120.75, do the math. 5 minutes later, you would have received almost 15,000 US dollars less for that same 1 million Canada, which is it's a big deal to me. I don't know if it's a big deal to everybody else. But it's just an example of how one thing in the market that's unexpected can hit and change the course of the way some big corporations can do business, because a $15,000 loss could have a lot big effects on your profit margin. Okay, so what, right? Where do we think the U.S. dollar is going versus a number of currencies this year? As was said in the introduction, we had some good luck last year. We were the top-rated G10 currency forecaster for two consecutive quarters, which was nice. And we like to think we know what's going on this year too. We'll see. In our view, the U.S. dollar is going to likely weaken a bit this year as it did last year. In 2016, one of the biggest drivers for U.S. dollar strength was this idea of policy divergence I mentioned a little while ago, where the U.S. Fed was on a path to raising interest rates while a lot of other major central banks were on hold or adding stimulus to theirs. In 2017, that changed a little bit. The U.S. Fed did continue its path of raising interest rates, but central banks abroad started to get on the tightening path as well. So the divergence between us in the United States and those major central banks closed a bit, and the outlook is for it to stay relatively tight, and that takes away from some of the U.S. dollar strength. And that happened last year, and we expect it to continue this year. One of the beneficiaries of a weakening U.S. dollar was the euro. In 2017, the euro gained 15% versus the U.S. dollar, and we expect the euro to hold most of those gains, if not eke out a couple more percentage points versus the U.S. dollar. As I mentioned before, the European Central Bank is moving towards tightening their policy. Most of the last 2 or 3 years, they had been pumping in $60 billion a month of quantitative easing into their economy, and they have shortened that or lessened that amount to $30 billion, with the intent of it running out in the fall of this year, which is seen as a first step into eventually hiking interest rates, probably not until 2019. The British pound, we talked about Brexit a little bit and how the sterling fell from the sky in the second half of 2016, but throughout 2017, the sterling has been a really resilient currency and has actually come back to levels we saw before the Brexit vote. While Brexit is still something that's up in the air, negotiations are ongoing, and there's definitely no deal that's imminent there. We do expect the pound to continue to be pretty resilient and probably close the year about 135, which is only a little bit weaker than it is currently. Another major currency we deal with is the Japanese yen. I mentioned before that's a safe haven currency. So as stock markets here and abroad have roared over the last year or two, the yen's kind of taken a back seat. But don't be mistaken. If we have a major correction in currency markets, you will see the yen gain significantly on safe haven flows. But as we expect stock markets to continue to do pretty well this year, we think the yen will probably close the year in familiar ranges to where we're at now, between 109 and 111. That's what we think, and I hope I'm right. But I'd like to pass on the mic to Dr. Min.
Well, my first name is John as well, so I'm John number 2. I think John number 1 did a really good job giving you macro perspective on the foreign exchange market and what we can expect. And I'm the first one to say among all the financial markets, the one that's really most difficult to forecast is the foreign exchange. And I'm kind of proud to say our team did number 1 last year among the Bloomberg. So we beat out all the big boys on the Wall Street as well. On that note, my job for the next 5 slides is to bring down the macro to micro level and kind of link it to what you do on a day-to-day basis. And I think one of the most important things that the audience should pay attention to or realize is that all foreign exchange transactions, those $5.2 trillion that's bought and sold, they're all OTC transactions. Technically, that's the over-the-counter transactions, which means it's not exchange pricing. You actually negotiate your pricing on every transaction with the counterparty. So the implication is, from a business world, if you call 3 different financial institutions, you're going to get 3 different pricing for the same size of the transaction. And more importantly, if you call one big financial institution and talk to 3 different traders, they will give you 3 different pricing. So there's no one price rule in the foreign exchange. And in fact, there's no official price. And in fact, if you're used to looking at FX Street or XE.com on website just to get an idea where the market is, those rates on the website are just indication rates. And these are for transactions of 20, 30, 40 million per pop type of transactions. It just a guess, an average. It's not really accurate pricing because the size of the transaction matters, the value date matters, and all these are negotiated. So again, most important thing you need to realize, all pricing is negotiated with your counterparty. Now, that being the case, the next bullet item is really, really important. If all prices are negotiated and you don't know whether you're getting good pricing or not, then it is really important for you to take control over the pricing or the exchange rates, especially if you're dealing with foreign overseas suppliers or businesses, so you're paying or receiving payments from overseas. In fact, one of the best industry practice is that whenever you're dealing internationally or overseas, you always want to have the option to do in either domestic currency, I guess in this case the US dollars, or the foreign currency. And one of the trick of the trade is that if you get invoice that's either expressed from your supplier overseas in US dollars or their domestic currency, all you have to do is divide those prices together, and then you get the exchange rate. And it kind of gives you an idea of what type of exchange rates your supplier is thinking of overseas, and whether that's fair pricing or not. Of course, now you have a problem. Again, there's no exchange pricing, so whatever the rates you get or the pricing you get from overseas, you need to compare that to something else to see whether there's a good price or not competitive price. So for that reason, it's really important to work with the specialist who knows the market and who's willing to give you what's fair and competitive pricing for every type of transactions you do. And let's go to the next slide then. So the next topic is really making a distinction between working with a specialist and working with banks. And I'm really surprised every time I go to UK, London, pretty much all the businesses in London, they work with specialists. It's just common practice. Obviously, you have a big banks like Barclays and things like that, but those big money center banks work with big institutions, and they're only interested in those wholesale trading type of business. But when it comes to small to mid-sized businesses doing day-to-day transactions, sending payments, receiving payments, moving your money from one account to another account overseas, the banks are not really catering towards that service, because at the end of the day, foreign exchange is not the main focus for a lot of these money center banks. Now, here's something else you may want to pay attention to. There are about 7,200 banks in the United States, and over 7,000, pretty much 97, 98% of these banks, they don't do their own foreign exchange. They don't have the capability to do it. They don't have the means to do it. So if you're working with community banks and smaller banks in your neighborhood, if you're doing foreign exchange through them, it's pretty much guaranteed they're outsourcing that transaction to one of the bigger banks in the United States. I call it the money center banks. The implication is very clear. You're going through two different parties, and actually at the end of the day, transaction or the pricing is done by a third bank you have no relationship with. As a consequence, you're going to see that the overall markup. Now, we've got to be a little careful with the markup. Technically, there is no markup in foreign exchange because there's no official price. So you're just getting less competitive, fair pricing on your negotiated price through a third party if you're dealing through your smaller or the regional or community banks. Now, if you're dealing with the larger banks, like say, and I'm not just picking on some of these banks, but just because people are familiar with JP Morgan, Bank of America, Wells, some of these banks all combined have about 70 to 80% of the market share when it comes to deposit and credit. If you're dealing with those larger banks, I suspect most of you are online with them because they are not really interested in providing a tailored VIP customized services to their clients. In fact, they would treat most of the transactions below $1 million as a retail transactions. So if you're online with your big bank, your credit facility bank, you are getting retail transactions. What's implied is that you're not getting the most competitive and fair pricing on your negotiated transactions. And of course, we should talk about the fees, but it varies. But I'm sure you all know banks are looking to generate more revenue because it's really hard in the current environment to generate revenue through the interest rate difference on the yield curve. So there's a significant fees involved doing transactions. There's anything that has involved international element to it. And then the pricing tends to be less competitive. The flip side of that is if you work with a specialist, and there are a few in the United States, the first thing you notice is that they cater towards working with the small to mid-sized businesses. So they provide relevant market insights and analysis. So if you're dealing primarily in euro, you can request that specific information. If you're dealing with mostly Asian currencies, then you can request that information. There are many websites out there providing foreign exchange or the rate market insight, but pretty much all of them are tailoring towards the day traders. And you're running a business. I hope you're not day trading at your desk. If you're running your business, then the market insight that you need is different than those people who are day trading, which means they're buying currencies every other hour just to squeeze out a couple cents and dollars here and there. So that's one of the main reasons why, to get the relevant information you need to make informed business decisions, it's really important to work with a specialist and ask for those tailored information. And more importantly, being able to pick up the phone instead of just logging onto online and doing a transaction, be able to talk to someone who can identify potential risks that's involved with your foreign exchange needs, and also providing you with a customized hedging. Now, obviously, if you're big Fortune 500 companies, you should be able to pick up the phone and call traders at big banks, and they will provide the same type of services. But if you're the small to mid-sized businesses, I suspect you don't have a phone number that you can call to your bank and talk to their traders directly. At the end of the day, they really cater towards the upper 20% of the big companies, even Fortune 500 or even bigger than those. Now, that being the case, because of all the technology and the improvement in technology and the fintechs and everything else, there are some really, really cool and very efficient international payment platforms that's out there that can be linked directly to your accounting software or your existing ERP. They're very efficient. You will be able to get on and do the transactions in less than a minute or two. You can get the relevant market insight, and you can do all that in addition to having a dedicated account manager who can walk you through the risk and the potential returns of managing your risk. And the next slide. Fundamentally, there are 4 different types of transactions, and I'm going to start from the basic, which is to your left, all the way to more sophisticated one. Obviously, some of you might be looking at it and say, well, you don't have really cool things like options. I'm the first one to say option is it's a hedging strategy, but something you need to know. The option is just like an insurance. So you have to pay premium. And right now, as John number 1 said, the market has been very, very volatile. So the pricing, the premium that you need to pay on options is so high. It really does not make sense unless you're involved in a specific situations where there is a chance that the project you're working on overseas may not go through, and you would like to have an option to just walk away. But if you're holding on to an invoice with a specific amount and a payment date, or if you are collecting money in overseas because you're running a business overseas, and at the end of the year, you're going to bring the money back, so you're running real business, then these 4 instruments should definitely help you run your business effectively. Obviously, most common in the United States is a spot transactions. Spot is you buy now and pay me today, and then wires or the transfer takes place within 24, 48 hours. The standard in the industry is we call it T+2, 48 hours. So your money will show up on your beneficiary's account or the account overseas. The next step up in terms of managing risk is a forward transaction. Forward, just the way it is, implies you buy today and you pay me later. The idea with the forward is it's very ideal. It's a perfect instrument if you're running a real business. So if you have an invoice from overseas with the payment terms of net 30 days, so you need to make the payment in 30 days, but you're concerned that the market has become very volatile and you would like to be able to lock down the dollar cost equivalent of that invoice and book it on your financial statement, then you can call us or you can call any of the specialists and you ask for the forward rate, which is the future rate, and for 30 days. In the industry, the standard practice is we can go from T+2, 2 days, all the way up to T+365 days.
And I can do more if I need to.
And then John number one says you can do more if you have something that's more than 1 year. I think the longest I've seen is about 2 years, right?
I can do up to 2 years.
We can do up to 2 years. So if you have a big project overseas and you have a budgeted how much it's going to cost, but you're really concerned that the 2019 is going to be very unpredictable and you don't want the budget to explode on you because you didn't hedge your currency, these forward type of transactions are fantastic. Now, as John number one says, the foreign exchange market is different than the equities market, so it's trading 24 hours a day. So a lot of the clients are getting more sophisticated, more comfortable with the foreign exchange market, and they see the potential for savings by timing the payment versus just doing the spot trades. They utilize what's known as a market order. All that is you will contact your account manager or the specialist. You request the amount of currency that you want to buy, and then also specify a target rate or the budget rate. So if you have an invoice or if you have a project, and in order to protect your profit margin or in order to protect your expected return on investment on that project, you can specify the rate you want to buy, and you place the order with your account manager, and you can just go back to focusing on your work. The market is open 24. A lot of specialists have capability to monitor the market 24 hours a day for their clients. So whenever we see that the price in the market, it could be happen in Tokyo, it could happen in Frankfurt, it could happen in Zurich, it could even happen in Hawaii. If we see that the market is there for you, then we can just grab and lock in the transaction and we send you the confirmation next day. One thing that you may want to be aware of is that during the course of the day, the major currency pairs like the euro, dollar, pound, US, you could see a movement of 100 to 200 basis points within 24 hours. And during the week, we have seen movements of 300 basis point to 400 basis points. So just utilizing market order and trying to time your payment, you might be able to save another 200, 300 basis points. And if your profit margin is 10%, we're looking at a 30% boost in your profit by just utilizing the market order, and there's no cost associated with it, right?
Correct.
Yep, there's no cost associated with it. The last one is the holding account. I think this is like the biggest industry secret out there. I'm so surprised that a lot of companies are not using this. If you have an operation overseas and you're receiving funds and you like to receive it in local currency, because at the end of the day, if you're doing business overseas, you have to be able to offer an option for your businesses overseas to do local transactions for them. It's just easier. It just promotes your business, makes it more global from their perspective. Now, holding account is almost like a virtual multi-currency account. You don't have to physically go over to overseas to open up a bank account, and I don't know whether any one of you have done that. I did that once many years ago. It was very painful. Not only that, you have to do it in person. There's a lot of cost involved. There's a lot of maintenance involved, reporting. In many respects, it really does not make sense to open up an account overseas with all the the fees and the compliance and everything else that's involved. With the virtual holding account, just opening an account with your specialist, we can set you up on a virtual multi-currency account where you can receive funds in any of these currencies that we trade. And at the end of the day, at the detriment of our business, if you receive funds in euro and if you have a payable that's in euro, you can send out the payment, thus avoiding the conversion. It's a beautiful account. At the same time, if you receive funds from overseas, you want to hold it there, and then you want to time your conversion back to US dollars, we can do that as well. For the same reason that we talked about before, the timing makes a big difference. And one last thing is this way you avoid what's known as a captive transaction. This is the dark secret in the foreign exchange market. If you're receiving payment from overseas in local currency, and your financial institution sees that it's going to your operational account in US, obviously your operational account is going to be US dollars. The receiving institution will convert that foreign currency to US dollars and deposit, and that's when you find out you received the money from overseas. The problem is you have absolutely no control over the pricing that we talked about. You're at the mercy of the receiving financial institution to convert at will, and we find that that's when you see that the negotiated pricing you got is after the fact, by the way. It's not as competitive as fair as it should be. So by having a holding account, you have a full control as to when you're going to convert, at what exchange rate you're going to convert. So again, you're regaining the control over your international transactions. And I think this is my last slide. No, I got two more, so I need to speed up a little bit. So this slide it's about simple hedging. And I know hedging seems to be I don't know why it's such a dirty word in US. In Europe, pretty much all the SMEs, they use forward contracts. In the United States, I'm still surprised that many businesses, they just use the spot market. As soon as the forward is discussed, they equate that to futures and options and something exotic and something going to explode, and it's not going to be something that the board or the management would approve. That being the case, I just wanted to point out that when it comes to doing simple hedging like forwards, there's absolutely no risk at all. All you're doing is you're buying today just like a spot, but you settle or pay on a given date up to 2 years. It's a fantastic way of protecting your budget or profit from market fluctuation. And more importantly, for those people who are working in accounting, this is a nice way to eliminate those accounting translation gains and losses. For example, if you're doing a budgeting, you got a project, you got receivable coming in from overseas, you book it on your book, and then obviously 3 months later, by the time you received it, based on how the currency may have moved, you may have we call it either book gain or book loss, and then you have to explain that to your audience or the shareholders or your management why you got more than you thought or why you got less than you thought. All that problem could be eliminated by using forwards. And I just wanted to give you a context as why this is so important. The graph you see to the left is the Euro USD. And as John was saying, last year, the Euro strengthened 15% against the dollar. So if you have any exposure to Europe, if you had to send any payments to Europe last year, during the course of the year, it just got more and more expensive. And at the end of the year, it cost you 15% more than you thought. So you would have had a book loss. And the other graph is the US dollar Mexican peso graph. And in this case, Mexican peso strengthened about 15%. It has been one of the most volatile currency. And obviously, it's exactly the same. If you have an exposure in Mexico, based on which side of the graph you're on, either you made extra 15% or you lost more extra 15%. And then these are book gains and losses, which can be eliminated by using forwards. And then my last slide, some of the best practices. We work with hundreds of freight forwarders, and this seems to be the industry best practice given the current market situations. I'm sure you do your forecasting on a quarterly or annual basis, but our recommendation is quarterly forecasting seems to make sense because the foreign exchange weather report changes constantly. So if you kind of know what you're going to do for the Q1 in terms of different currencies for all the items you want to settle, which is on your right, then you can simply figure out how much euros you need, how much pound, how many yen, and Mexican peso, and you should hedge 70 to 80% of it. That pretty much guarantees that your budget is going to be protected. Only reason why we don't recommend 100% hedging is I'm sure your forecasting is very accurate, but there's going to be a little bit of delta at the end. So it kind of gives you a room to kind of say, okay, well, we thought we were going to do this, but we did a little bit more, a little bit less. That gives you the flexibility to adjust. Second part of this best practice is that a lot of our clients who are doing these forwards, once they lock it in for next 90 days, then they don't have to worry about the exchange rates at all. They know exactly what it is, and they share that information internally to all the relevant parties. So there's no more guessing as to how much things going to cost, how much you can expect from overseas. If everything is going to be based on fixed internal rates or pricing, and you can just draw down those payables and receivables against that forward as they come due. And one last thing, this is the time saver for most of you. A lot of these payment platforms, online platforms that specialists provide, they can link directly to your accounting system. It's a simple link as to batch download, batch upload. It only takes about 30 seconds. So in terms of reconciling at the end of the month, at the end of the quarter, generating customized report as to which currencies you bought, which currencies you sold, it can be done very easily nowadays. It's going to save you hours of work by just integrating this system. And that's my part, and then I'm going to turn it over to Andrew.
Great, thank you, Sean. Appreciate that context on the micro level. I'm going to be talking now about a little bit about the future and where we see some interesting developments happening in the markets that can affect not only the foreign currency markets, but a lot of the way businesses do various core processes using some of the underlying technology that's driving some of these cryptocurrencies. So in the past year, really, crypto has really got on everyone's radar as we've all been reading the newspapers and seeing, numbers that are going through the roof. But I just wanted to give a quick sort of context of where we're coming from. So this is not something that just happened last year. It goes back about 20-odd years into the early 90s with a group of techies called cypherpunks who were really libertarians who were dedicated to cryptography and privacy, not secrecy, but privacy, and a dislike of third parties, of unreliable and costly third parties. But the technology really didn't go anywhere. It was a solution without a problem. And then the 2008 financial crisis happened, and there's a tremendous lack of confidence in the markets. And that's when, in 2009, Bitcoin, using that early technology, first came into existence. Again, still, no one knew how this quote-unquote currency was going to be used. In 2013, you may recall the collapse and criminal arrest of a website called Silk Road, and Silk Road sold all sorts of illicit products. And people paid for those drugs and weapons and things using Bitcoin. So it got off to a very negative start. A year later, Mt. Gox, which is a Bitcoin exchange, a repository in Japan, was robbed. 750,000 Bitcoins were stolen with a market value of $400 million. So again, volatility. And today, that same $400 million would have a value of $7.5 billion. So, just to show you where the price of Bitcoin has moved in the past few years. Inevitably, regulation follows innovation. So in 2015, New York State came up with the first bit license. And so, the regulators are now coming into the scene. And last year, as I said, the currency has really gained sort of public awareness and public consciousness. It's now traded on it's quoted on futures. So it's really coming a bit more into the mainstream. The currency was, who started Bitcoin? There's this infamous Satoshi Nakamoto. He's a retired developer out in California. He denies it. His name is Dorian Satoshi Nakamoto. You can see his photo here. But really, there's other technologists out there, and it's either one or a group of them, and it's still a mystery. So that's why I've got our question mark here. But he denies it, but there are several of these technologists that were working on it. Excuse me. So what is Bitcoin? Well, there's 16 million of them in circulation. A total of over 21 million can be issued in total. They can be divided up to 100 million each. So there's plenty of room to create more. It's a digital asset. It's a digital money. But the key thing to note about it is that it has no backing of any government or central bank, unlike the dollar or the euro or other what are called fiat currencies. So that's a very unique distinguishing characteristic of it. It's designed to facilitate peer-to-peer value transfer, and open source software is the foundation of Bitcoin and other cryptocurrencies. The key elements too is that transactions are recorded on a distributed ledger. We'll talk a little bit more about that. And this blockchain technology is what's supporting the distributed ledgers. Miners are maintaining the blockchain, ensuring the integrity of transactions. And with the start of Bitcoin, miners were awarded Bitcoins if you will, as a sort of payment for maintaining the blockchain. And those amounts of Bitcoin they're getting are going down and down and down, and lower because they're becoming worth more and more. But these currencies are now these cryptocurrencies are now available on a lot of different exchanges that are popping up. So that's how they're traded and made available to companies and individuals. Encryption is a very key piece of this to ensure security and privacy. And part of the dream of the cryptos is that it will allow, in terms of payments, allow things to, not just payments, lots of transactions, to allow the transactions to move faster and less expensive, remove friction from the system so it's less costly and more efficient. And of course, though, there's still a lot of debate about these currencies, what they are. I mean, Tempus could start a Bitcoin tomorrow or a Tempus coin, and what value does that have? I mean, what is money, and who, if two parties agree something is worth something, then it has some value. So it's challenging the concept of money, and it's still an open debate. So we're watching it to see how this may unfold. In addition to Bitcoin, there are thousands of other cryptocurrencies, and they're collectively called altcoins, alternative coins. In fact, there's over 4,500 of them. You can see Bitcoin has a market cap of 177 billion, which is a huge chunk of the total market cap of these cryptocurrencies. But the top 10 have 82% of the total value of cryptocurrencies. And I've listed here 3 of the other ones beyond Bitcoin, one called Ethereum or Ether, another one Ripple, and Bitcoin Cash, which is separate from Bitcoin. And the values of these are changing constantly. As we were preparing this presentation from 2 days ago to today, we had to adjust the numbers because they've been changing so much. So you can see the dropping 20% in a day is very normal. These currencies were up a lot at the end of last year, and they've already lost 50% in just a couple of weeks. So we're really all over the map. But these are some of the key ones that are out there. But there are many others, and most won't amount to anything. So as we look at Bitcoin, it's been really a wild roller coaster ride. We've seen tremendous volatility, as I mentioned. In fact, in some instances, it seems like part of this is completely absurd. For example, there's a company on Long Island that distributes iced tea, the drink iced tea, and they're called Long Island Iced Tea. All they did was change their name of their company to Long Blockchain, and the company value doubled, basically from roughly $30 to $60 million just by changing their name. They're still distributing iced tea. There are concerns about liquidity, all these different exchanges. Can you get your money out if you have Bitcoin? A lot of there's a wide range of quality among these platforms. Security is a big issue. The hackers are actively trying to steal the Bitcoins. It's an asset, a digital asset. And so there's attempts at theft of where these cryptocurrencies are held. It's also the perception, that it's very anonymous, and the encryption makes it anonymous. It's extremely appealing to criminals. So there's that element in the mix too. The regulators are coming in. We see speculators, and the infrastructure of some of the different platforms is very, very much still in an early stage. Coinbase, one of the major ones, trading a lot of the cryptocurrencies, is frequently stopping trade. There's lots of delays, so it's sort of the Wild West. We're in the early days of this, and it's yet to see how this will play out. But there will clearly be a shakeout in the infrastructure as the emerging platforms dominate. In the sort of the overall ecosystem. 20 odd years ago, we had just the sort of techies in their garage talking to each other in chat rooms about the technology. And now we have this massive sort of ecosystem of players that are surrounding both the cryptocurrency and the blockchain technology. And the blockchain technology is increasingly becoming much more interesting to a lot of players that are looking at this crypto and underlying technology. Banks, for example, are trying to use the technology across a wide range of products, loans, payments, stock trading, letters of credit, to move a process through in a secure way. Payment companies, there's a lot of movement now about trying to use crypto as a remittance to send money to, say, for example, African countries because of the problems with the currencies in those countries. So can crypto be a possible substitute for local currencies? Venture capitalists are investing in startup companies that are focusing on the technology. Fintechs are continuing to pop up to pursue all sorts of opportunities using this technology. And companies in your industry have to now start to get their head around the technology and what it can mean for logistics and freight and moving product around the world and all of the documentation and support required for that. This technology can definitely lend itself to making that process more efficient. One of the banks that we work with, Barclays, has an initiative, just to give you an example of some of the scale and scope of what's envisioned. And they have a project they're working on for letters of credit, which in a traditional letter of credit, in general, it takes about 5 days for all the documents to be signed off and moved back and forth between the parties. And their technology they're trying to deploy is trying to reduce that from 5 days to 5 hours. So it's sort of revolutionary if they're able to achieve it, right? And there'll be many big initiatives, and some will be successful, others won't be. I think just to show you what this is, this blockchain and the distributed ledger. The blockchain is, it's decentralized, and all parties that sign up with it, you have to join this network, you have access to it. And a distributed ledger is all of the debits and credits, or the entries that move for an individual transaction. So what we all would call one payment could have multiple debits and credits between the institution sending, any intermediary, bank, or other financial institution, and the folks receiving the money, the beneficiary. So all of those debits and credits are locked in the distributed ledger and transparent. The names are encrypted, but all of the players have to know what goes into them for anti-money laundering and for transparency. But it's a very robust platform that has a lot of potential, and we're just really in the earliest of days. So we really wanted to try to help you to visualize how the ledger works and the blockchain supporting the ledger. And this is sort of the flow of how it all works. And the reason why transactions move quickly is nothing can happen until everyone agrees it's okay and they agree. So the sending institution, all of the beneficiary details, everything is confirmed. And when it's all agreed, then the transaction settles definitely, instead of moving from one party to the next in the current sort of payment system, which takes a lot of time, can take days, it now can take seconds. So that's what the blockchain is trying to do. And as I said, it can be transformative. Healthcare records, your industry, individuals can have their own personal information, their social security number, those sort of things, and have it in blockchain and control that instead of having others control it. So we're in the very early days, and we'll see how it plays out over time. Quickly, so what we're doing right now here, we're continuing to analyze what's happening with crypto and the technology, talking to clients, asking about their impressions and their potential needs. In Q2, we'll be formulating plans. In the third quarter, developing things that we think our clients want around either the crypto itself or the blockchain to help us move payments faster, and then implementing and supporting it in Q4. This is sort of a rough timeline, but we're sort of at this point. To date, we haven't had a huge demand from clients. We had one that asked that is converting from yen to Bitcoin. It's an early stage one. Japan is a little more proactive than other sort of advanced economies in terms of using crypto. But we're curious to see what types of things our clients are going to be asking for in the future. Just sort of shifting gears, and it's sort of good to have compliance follow crypto because there's so much concern on compliance and the cryptocurrencies. But when your funds are moved around the world to settle your international transactions, you want to make sure that the parties you're working with are highly compliant. It's a very regulated process of moving, the fiduciary responsibility of moving money around the world. Funds are obviously moving electronically. There's a lot of emphasis on cybersecurity and fraud detection software, and there's big costs in terms of maintaining the compliance infrastructure. Some of the things we're seeing around money laundering are hacked emails, and this is something that we really encourage you to look very carefully. When you receive an email from an overseas vendor with their beneficiary bank instructions, that email might have been hacked. So if you then give that to us or your bank provider or whoever, you're just passing on hacked instructions, and it could be a fraudulent transaction. So you have to be sure that the communications you're receiving are trusted. Layering of payments is a way of just moving money around the world without any real purpose, just to disguise it. Funds sent to high jurisdictions tend to be riskier and require more vetting and due diligence. And phishing is also something where legitimate organizations or people have their identity stolen, and then those legitimate identities are used to perpetuate fraud. So these are some of the key things that we see. It's important in this sort of battle against money launderers and fraudsters that the provider and the client have a close working relationship. We'll ask clients for additional information if we have a question about a payment, just to understand the nature of it and the nature of the transaction and the recipient, so we know that it's completely legitimate. Just sort of our last slide on compliance. The components of a real program that one has to have. First, we have to be compliant with all regulations. We're U.S.-based, so we've got FinCEN and OFAC and the Bank Secrecy Act. We comply with all of that. North American standards are some of the best in the world, so actually other governments around the world copy a lot of what we're doing here. We have to have ongoing transaction monitoring, both at the initial transaction and all transactions through the life of the relationship. Staff receive initial training as well as ongoing training, and we do extensive due diligence on clients when they first onboard with us, just to make sure that they have a legitimate need for transacting internationally. And good programs have some manual components. By that we mean we can, not everything is just an automated software and tracking. We have human intervention that is actually very effective in tripping up fraudsters. So if you send us an email with a new beneficiary, we're actually going to pick up the phone and call you because we want to make sure your email wasn't hacked. So we'll just verify. Those sorts of little things like that can be very effective. Programs have to be audited. We have outside auditors that come in and look at our whole program to make sure it's up to standards, and then our state regulators come and audit us, and they look at that independent audit to make sure our program is good. The board always has to overlook what a company is doing to make sure the programs are compliant. And lastly, flexibility. Markets are changing. Fraud and money laundering techniques are always changing. We can't have a program that's totally etched in stone. It has to be flexible to adapt to the market reality.
All right, this is John 1, or not Dr. John. So to wrap it up, and here on the screen is a summary of what we talked about, and while you look that over, I'd like to address at least one of the questions we got on the from the listeners there. One was, what are the costs involved with hedging? And the costs are really, there are no costs to hedging. If in fact you come up with a plan where you're buying a simple forward contract, what you would do is you would agree on the price of what the market is now with your bank or specialty firm like with us, and the only cost would be there are forward points involved in when you move that spot transaction, that's the T+2, out to 365 days. And it's a very complicated math formula, but essentially you're looking at interest rate differentials between the United States versus the European Central Bank, for instance. So there's a small cost there, but that's just the market cost. It's not an additional cost. And so what you'll do is you say, today I agree to buy 100,000 euro at X rate. That's the dollar amount that you will owe at the end of the contract. There might be some margin involved where you have to give us a deposit that you put on hold, but companies like us and banks also provide credit facilities, so perhaps you're not even putting a deposit down on those currencies. So an overall cost, there is no cost. It's just when you actually settle the transaction, what is the dollar amount or the currency amount that you will owe. So that's really it for us. I think we're out of time. But for listening there, if you have any follow questions, you want these slides or any more information regarding compliance or hedging or our market updates, you can email that email address there, and we'll be sure to get it to you.
Thank you, John. That concludes today's webinar. I want to thank everybody for joining and thank all of our speakers from Tempus for putting together today's presentation. I just want to remind everyone that credits from today's webinar may take longer to post due to January renewals. Also, if you didn't receive your renewal notice, they went out on Friday, so please email me so I can resend it to you. Thank you again for your participation and enjoy the rest of your day.